My
Yeah.
man, you are in an absolutely blessed position. You're in an RH digital asset before it's even deployed. You just can't get it any better than that, in my opinion. So what Cookies is saying is very true, man. You're you're in a beautiful place, man.
Yeah, honestly, I've never been in first mover's position before anyway. So blessed in that
Well, yeah.
perspective. I'm blessed to be even be there before the bus. I'm on the bus before even the engine started to warm up. So it's cool.
That's why all these other passengers that have been on the bus a long time trying to tell you, my man.
Yeah, if I had to choose, if I had to bet, if I had to do anything, I'm betting on RH, man.
Feel like, okay, so I feel like this is a whole new, okay, so I feel like this is a rerun. Like literally, I feel like I was here a year ago. We were talking about the same thing. So I'm just going to say this. It's May because he said last year in May it's going to be May. So it's May. I'm just going to say May.
Exactly, Susie. He said it may come out.
So we've watched this evolution go on with Richard from day one of the AA all the way on up to today, and I feel like there's just been just an absolute reckoning with regards to how people are forced now to look at the force of Richard Hart. The people that called him the scammer ended up being the scams themselves.
Yep.
And with Pulse Chain coming, just in the industry, just speaking to tons of different people and tons of different devs and just new individuals every day, big whales, big entities are coming over to Pulse Chain. I think that once Pulse is live and individuals see the code and can go on testnet and start building against it, and the reality of Pulse Chain here is birthed. I think that what CZ is saying is very true. That it's kind of a rerun, but this time around, people know that RH is the exact opposite of what they all said that he was. And Hex is not some scam. And Hex did not die. It did the exact same thing as every other damn digital asset does its first cycle, except for it went down 96%. You have a copy on top of that, and you've got Pulse Chain on the way, which is essentially the next gen version of Ethereum, faster, cheaper, fee burning, with an entire ecosystem built on it. There's a lot of people looking at Pulse Chain because of the reconciliation that Richard has had through this bear market. He has been proven right about damn near everything. The only thing that Richard was wrong about was when the launch of Pulse Chain was going to happen, and that's a very powerful thing. So I think that the speculation on Hex can probably get out of control once they do see testnet, once they do see Pulse Chain and realize that it is there. I think that the excitement is going to be very powerful. In terms of price, I don't know. I don't care. But I do know that this time around, it's getting very difficult. And the voices that were saying the things that they were saying about Richard from day one of the AA, they're starting to die on the vine very quickly. You just don't hear people saying that stuff about Richard anymore. Ivan on text, no joke. He has an absolute ton of people in the industry that work with him. I guarantee you he'll be validating. He'll have tons of validators running on the network, probably. So it's going to be very interesting to see, because when you've got credible people that can start talking about the actual code base and what it's doing, people are going to take very quick attention to that.
Especially when you have the Genesis wallets from Ethereum in Pulse Chain.
Yeah, I think that people will be surprised, and I'm just my personal opinion, but I think that once mainnet is deployed, you're going to see large entities that you can't believe deployed actual real protocols that are running businesses on Pulse Chain, because they just can't do it on Ethereum, and they prefer to not do it on an L2 that is contingent on the L1. So Pulse definitely is going to be a very attractive option for a lot of different reasons. But we're going to be only looking at about probably 5-6% of the total supply of Pulse actually circulating, right? So a lot of people understand the speculation on Pulse and what it represents as a new kind of next gen version of Ethereum. So when you're looking at where we're at and the demand of the individuals who sacrifice, we're all crypto people. There's a massive amount of new demand for Pulse. I see it every day. I hear about it every day. I know millions and millions and millions of dollars are coming in after Pulse the second the thing goes live. So there is a just base level logical conclusion that you can, an outworking from this, that there are major entities that benefit and are massively incentivized to see Pulse Chain do very well. We're not far from the next Bitcoin halving and the cycle turning up from that Bitcoin perspective. And so you just need to learn how to just park whatever economic energy you feel you're comfortable with over a certain time horizon.
From a Pulse perspective, you're all set. But like, how about from a Pulse X perspective? Like all that, the $1.3 billion that went into Pulse X. How is that? How does that play out? Like, is Pulse? I know Pulse X is an exchange, just like Uniswap. So will over time it? I mean, at first the Pulse is going to have all the energy, but over time, does
Well,
Pulse
that's not
X?
necessarily true, right? Obviously, there's a lot of people that sacked for Pulse X that need Pulse, right? That's a no-brainer. But I've got both. And if that ratio in the beginning goes too low and pushes heavily in my favor in terms of my pulse bags, so let's say, for example, the pulse X ratio is 5-1 and it goes down to 15-1 or 20-1, and I can get 20 pulse X for one pulse. You think I'm not going to be buying a shit ton, swapping into that pool a shit ton of my pulse? Absolutely. Absolutely. So there's a lot of people that have pulse that understand ratios in terms of the valuations of these assets. And if those ratios go too out of whack, they're going to get swapped into.
So how does that help? How does that help a Pulse X holder?
Well, what it does is there is 140,000 sacrificers for Pulse X that on an average paid, sacrifice a certain amount of money. And when it translates into value, it translates into a certain dollar amount on average, right? So for Pulse X, for Pulse, it's 3 zeros and a 1. So when you have the large amount of individuals that have an average cost basis for an asset, for the most part, they're not looking, unless they're in a financial hardship and they've got to sell at a loss or break even, they're not looking to sell at a loss, right? So it becomes very difficult to get to a SAC price unless you have people willing to sell into that immediately at a break even or a loss. And so if that does happen, there's going to be people on the other side of that pair that are willing to swap the overvalued pulse into the undervalued Pulse X, which brings that pair, that ratio back up. We don't know when that's going to be or how that's going to look, and that's what Cookie's been talking about this whole time.
So basically, it's going to equalize at some point in the future. It's going to.
No, the point is that we don't know, but individual traders will value opportunity and they will seek to go from overvalued, diversified into undervalued. But that's a case by case basis, a trade by trade basis, and also is only applicable to the people who are trading actively. But so to your real question, right? So I get this sense, I'm hearing the choice of words, I'm hearing the tone. Sounds like someone's got a fuckload of Pulse X and they're kind of hoping that they didn't pick the wrong mascot. Is that fair?
That's fair. That's
okay.
Really fair.
Okay, so check this out. Don't freak out. There are 4 really good investment opportunities in front of you, and you own one of them. So pat on the back. You did a great job, okay? Unless all the shit crashes and burns, goes to zero, then we're all fucked, right? But we're just going to take the optimistic side because that's way more fun and probably more realistic. So you're doing fine, man. One of the ways that you can fuck up the good progress that you've made is by psyching yourself out and trying to do too much too fast. So just chill the fuck out. You already have a winning horse, and pat yourself on the back. Helps the horse go faster too. You can pat it on the back.
Yeah. Like
if you want exposure
like
to the other
there's a lot of plays though.
Capital.
There
are, and you want to know what I've seen?
But
I've seen years and years and years of people come to the poker table and think that they have a lot of really good plays, and I leave with their money. So don't psych yourself out. If you don't know what the play is, don't play. You have a winning horse. I'm letting you know you have a winning horse. That's the objective that everyone in the room has. Just pat yourself on the back. And if you start to doubt that you're on the winning horse, there are no rules against trying to afford another horse. you don't have to get off the one you're on. You can begin to buy a position on another horse, and you don't have to do it on day 1 or on day 2 or on day 1,000. You have all the time in the world, your time, which is more valuable than any of these fucking made up magic internet money tokens. So just pat yourself on the back. And if your curiosity bends you and poisons you to say that other fucking horse is outpacing us, then I would encourage you to do whatever you can to bring additional funds to the table and back that horse with those funds, because you're going to have a lot of friction trying to jump off a fucking moving horse onto another moving horse. So couple of technical things for you. When you were asking when is the snapshot going to happen, so the word snapshot's a little misleading. What actually happens is we go from a testnet environment to the real deal, baby. And the way that works is that we actually have the testnet sort of pretending to be the mainnet, okay? And then we have the mainnet code, which is ready to go public, running alongside Ethereum's mainnet. And we say, okay, when Ethereum reaches this block, we call it a block height. It means like the next block in the chain. When it reaches that block height, that's the same block height that Pulse Chain will go live. And so that moment, everything in the system state of the Ethereum mainnet network will be identical on Pulse Chain. That's the snapshot. Right when Pulse Chain goes to mainnet, the block height, the genesis block at which it begins mainnet production, is the snapshot. Does that make sense?
Yeah, so there's no difference between going live and snapshot.
100% correct. You got it.
And also to add to that, it's been well known within the community, and just obviously, there'd be ways that outside players could probably work that system in their favor. More so to the reason why we are consistently telling you there's no way for no one really knows. So it's a design, right? Not a bug.
So the other thing to keep in mind when I think it was you that was asking about, like, could the sacrifice or could the main net price of the thing you sacrifice for, could that price be lower than the prorated value of the sacrifice points? Was that you that I was asking that?
Yes, that's what I was asking.
You bet.
You put it more eloquently than me, though.
Hey, no worries, brother. I've been talking about it for a while. Everyone's already said, right, it'll launch at 0. But the thing that's a little bit misleading about that is price in US dollar terms is not what denotes money. In contract law, it's what we call consideration. And so if you came to me and said, hey, I have 10 apples, but I really want your Pulse chain. And I said, oh, no problem. Let me send this Pulse chain to your wallet in exchange for those 10 apples. The legal consideration that was made there is that you and I speculate on the value of apples in terms of Pulse chain coins, and we find an agreeable social contract to engage in. And that swap that occurs, even though it was me sending digital shit to your digital ownership and you handing me physical apples, that was a legal consideration. So even though there's not a US dollar price on the coin, due to the efficient market hypothesis, all liquid assets are exchangeable for one another at a virtually frictionless exchange rate, which is agreed upon at the social contract consensus level. So if you have these made-up internet magic money tokens sitting in a magic made-up internet money wallet and you believe them to have value, that's one thing. But until you engage in a social contract or an exchange in the free marketplace with those, we can call them assets in this context, that's when it becomes imbued with the power of legal consideration and has money tied to its inherent value nature.
So the quote-unquote sacrifice has nothing to do with anything else.
Correct. It is totally separate. And the in the world, after the sacrifice details are set aside, right, we've accepted that those are totally separate. Then when we go and we look at Pulse Chain itself, we could say, okay, what if, let's say a couple of days or a few hours even after this thing goes into mainnet, what if there's a bridge to Ethereum? And what if there are these assets on Ethereum that have dollar value, right? And if they get bridged in, and we understand, much like the liquid market hypothesis, that there's this highly liquid decentralized exchange where these assets can be priced against one another. In the case where one half of that agreement of price is backed by dollars or by symbolic representation of dollars, we would say, okay, the price could go below what I was prorated in this weird point system when I sacrificed for Pulsechain. That could very well happen. Even though there's infinite demand, right? Don't let anyone fool you. None of us in this room can tell the future. Nobody can guarantee that there wouldn't come a time where the price of Pulsechain or Pulsex could be less expensive than whatever you believed you were buying or something during that sacrifice event that took place in the past, right? Does that make sense?
Yeah, that makes sense. It's all the market. The markets will weigh in,
You got
and
it, baby.
that will be
Hey,
the
Cookie,
Yep.
speak to the original LP provider and how that's set
The
up. Because,
like the AMM bot, are you saying?
well, you know,
Or
there
you're
will
saying
be
like the
initial
first users
LPs
in?
set for a Pulsex pair, for example, and
Mm-hmm.
then we'll be able to take, for example, a hex price on ETH or
Mm-hmm.
something like that and derive value. But it'll happen very quickly, obviously. But explain to everybody with your eloquence how that initial LP is set up, because the next trade determines the price.
Sure. So that will rely on both Uniswap v1 and Uniswap v2 logic. And what I mean by that is there's this concept called, and I know that you know this, Mando, but I'm just speaking to the room, right? Called the automated market maker. Automated market maker, which runs what's called the constant product model. And the constant product model, which is the mathematical formula used by Uniswap v2 to discern the price of two commodities in an exchangeable pool or a tradable arrangement, is X, which is asset A, times Y, which is asset B, equals K, which stands for constant. And what that means is for every exchange that is made, we could say apples and oranges. If apples are X and oranges are Y, there must always yield this total agreed upon value based on the assets that exist on the table available for trade at that time. So if nobody added more liquidity and nobody removed more liquidity, there becomes this exponential inversion relationship where the more of asset A that you convert into asset B, the more drastic the change in the required input of A to achieve the same output of B. So if you trade one apple for one orange, but the liquidity doesn't increase or decrease, the next time that you try to make an exchange for apples and oranges, depending on how much of each existed initially, it'll actually take more than one apple to get one orange again. And as you continue trading your apples for oranges, it'll take more and more and more apples to get that one orange. And so what Mando is referring to with regard to the people that are putting up liquidity initially is that you're going to have this DEX, right, called Pulsex, that'll be full of every token under the sun, including Pulsechain, including Hex, including Pulsex, including a copy of Shiba Inu and Chainlink and these other ERC20s that are now turned into PRC20s. And when the bridge opens, or do you want me to talk about pre-bridge liquidity, Mando?
Well, yeah, because it's very important that there will be ratios set by the LP before there's even a
Yes.
bridge, number one, and
Right.
then the bridge connects.
Yep. So before the bridge opens, and we're talking about ratios, that's kind of the apples and oranges example. Okay, and so if the original genesis state of the liquidity pools in Pulsechain deem that one these are just totally made up numbers, you guys, but if it deemed that one Pulsechain coin was equal to one hex, you're going to run into that same X times Y equals K formula, and individuals can view the current ratio based on the supply that exists within a liquidity pool, and they can provide liquidity in the form of both assets, because this is Uniswap v2 logic, constant product market or constant product model. They can provide proportional contribution of asset A and asset B. So if you hold Pulsechain coins and you hold Hex on Pulsechain coins, and the ratio is 1-to-1, you could put up 100 Pulsechain coins and 100 Hex coins and thicken the liquidity, and it will service all feasible ranges of price, because even if no one ever adds more liquidity and no one ever removes any liquidity, the way that the constant product model works, you can technically trade forever, even though you have this idea of like finite assets available for trade. The exponential inversion of price will allow you to pay an infinitely higher cost of asset A to achieve one of asset B, And even if there's not one of asset B left, you're going to just pay this infinitely high price for an infinitely small fraction of the other asset. And so as liquidity providers, you will be exposed to what we would call impermanent loss, or other people refer to it as opportunity cost, insofar as you can provide that liquidity and you can be the beneficiary of what we refer to as fees and slippage. And what I mean by that is you're going to put up some apples and some oranges. And even if you kind of know deep down in your heart that apples are just way more valuable than oranges for some logical reason, and the market agrees and they say, hey, I appreciate you putting apples and oranges on the table. You can have all my fucking useless oranges because I want those apples. While you will be given these oranges, you will be given them in a disproportionately greater award the further and further the market decides that they want apples. So in a world where apples and oranges are both nutritious, delicious, and have some caloric value to your body, like say a useful coin and a useful alternative coin, if you put both of those into the marketplace and you say, market, do whatever you want, take as much of either of these as you want, you might be left with one coin, and it might not even be your favorite of the two. Maybe it was your second favorite, right? But if the market decides that they really, really want your favorite coin at the cost of your second favorite coin, you will receive a disproportionately greater benefit of the coin that they deem to be less valuable. So in terms of market prices, to make this a little less ambiguous, if you have Pulsechain and Hex, and it turns out that on day one of mainnet, before a bridge exists, everybody who missed out on the Pulsechain sacrifice really, really, really wants the Pulsechain coin, well, you could put up liquidity in the form of Pulsechain and Hex, knowing that a bunch of these people who are able to buy Hex today fork are going to use their copies, which will land natively in the Genesis block of Pulsechain, to swap from Hex into Pulsechain so that they can get their hands on the native fuel coin of the blockchain. You might say, hey, well, I've got a little bit of Pulsechain, I've got a little bit of Hex, and I really want more Hex. You could add liquidity, allow the market that's FOMOing their swap from Hex into Pulsechain to give you a disproportionately greater benefit or fee, we might say, of Hex coins to give up whatever Pulsechain coins you were willing to offer as liquidity. And so the opportunity cost there might be, what if it turns out that Pulsechain is the best performing coin and you gave it up? Well, you've got this other thing, and hopefully it's going to perform better than fucking dirt. That's kind of the trade-off. That's the opportunity cost or the impermanent loss, right? And so that's why a lot of hexagons are so bullish, is because you kind of feel like you can't lose. You're either going to end up with a shitload of something really good or a shitload of something else that's really good.
Yeah, and just to piggyback off that, to make it like grade level, let's say I'm the original LP provider and I set up the ratios 1 pulse X to 1 pulse, right? So you have to ask yourself the question, if you're ratio trading and you see a 1-to-1 pulse X to pulse pair, which one are you going to move into and push up?
Right? I need to stop you right there, dude. I don't think 1 pulse to 1 pulse X will ever exist.
It was an illustration for basic learning, brother. Let's say it starts at a 5-to-1 then. Whatever you like. Doesn't matter, right?
Sounds better. Yeah, it sounds better. Yeah, it sounds better to me.
5-to-1, it'll take 5 pulse X to buy 1 pulse. Let's say somebody sets it up at that. So there's going to be that initial offering of a 5-to-1, and then the market is going to immediately push one of those assets in the up direction and one of those assets in the down direction and change that ratio. Until a bridge comes, you won't have that USD value connected to it until real value comes over the bridge. Once that real value comes over the bridge, you'll have that USD value connected to whatever that ratio is between those assets. And I highly doubt that when it actually does come in, that you will see a less than 3 zeros and a 1 price for Pulse in USD, because everything being done with the AMM, with the liquidity that's being harvested is being done to maximize the security of the value of the assets that Richard's created.
Flip side of that, you got a bunch of people that have been waiting for fucking 2 years to get their money back, and they might capitulate and just fuck up all those ratios. Nothing is knowable. Everything's a scam. Get out while you still can, but you can't because you're locked in. It doesn't even exist. Ha! Right? And so here's another thing that doesn't often get talked about. A lot of people, so you've heard about this concept of this like arbitrage bot that the Pulsechain team is going to deploy, right? Have you heard of that thing?
Yeah, the AMM bot.
The AMM bot, right? So a lot of people, when they discuss that facet of the launch, look at the balance between Pulsechain, Ethereum, and these ERC20s that exist in liquidity pools currently, like in Uniswap. Okay, and the reason that they focus on that is because at the time of the fork, right, the snapshot, as we might say, each ERC20 is going to have a 1-to-1 copy into a PRC20 equivalent, but Ethereum, or Ether, which is the ERC20 of Ethereum, is going to get a 1-to-1 conversion into Pulsechain. And the reason I say conversion is because the supply of Pulsechain, right, is going to be much, much larger than that of Ethereum. And so whereas Hex will be 1-to-1 its same supply on both chains at the time of the fork, Pulsechain will have a significantly higher supply than the supply of Ethereum. And so if you have a liquidity pool in Uniswap on Ethereum, and let's say it's an Ethereum Hex liquidity pair, the time of the fork, if your liquidity has been left staked in the protocol, when it forks, that bot is going to identify that where there would have been this really high value, low supply Ethereum paired with relatively higher supply Hex, now there's this really low supply, really low relative to Ethereum priced Pulsechain with the same number of Hex, right? And so the bot goes in and it redistributes and takes Pulsechain that it has been just gifted from the heavens in order to restabilize that trading pair so that it would remain virtually on par with the quantitative ratio of value between the Ethereum and the ERC20 now in Pulsechain and ERC20 terms. And so the reason I bring that up is because the AMM bot is going to do everything it can to present the market of Pulsechain to be virtually identical to the market of Ethereum. However, equal as they may be in all mathematical, logical, fundamental analysis of ratios, right? The amount of Pulsechain and the amount of Hex, the market participants who are eagerly looking forward to the opportunity to acquire some of these assets on Pulsechain, that behavior differs from their behavior that currently is in play on Ethereum, and that's due to things like fees, right? So when the market is set and the bot has taken care of the pairs it cares about most due to economic energy, what have you, liquidity, what have you, all that does is assure that everybody has an equal opportunity to get fucking whipsawed by volatility. And that's not a bad thing. What I mean is, like, a lot of people have a lot of different ideas, a lot of different strategies. There might be some trends that we extrapolate, given some of the information we know about people that did or didn't sacrifice, may or may not have coin coming to them. But ultimately, the stage is being set for a fucking earthquake. So I think what you will find is, regardless of did the price go below SAC, is it above SAC the whole time, any of that kind of stuff, you will see volatility so fast and so violent in both directions as the market services higher demand than liquidity can possibly feasibly in like human perspective service, right? Because we're bound by this like linear perspective of time, and in 1 second millions upon millions of trades could be occurring, flowing in both directions. The chart, in hindsight, will have a wick down and up as far as your imagination can allow it to go. And so if you are trying to participate in that environment, until things cool off, you can reasonably expect enormous volatility. I don't know if that means that you'll come out on top or you might come out behind. I don't know. It'll depend on the marginal instance of order book flow in a relatively decentralized marketplace with a shitload of demand hitting it all at once. So by the time things have settled, and that's why I said if you give yourself a little bit wider time frame, maybe it's 38 minutes, maybe 2 years, it starts to paint a pretty reasonable picture. Then you look back and you go, wow, 2 years ago it was less expensive than it is today. And that's going to be the big takeaway for most folks. That doesn't mean that you're a bad person if you want to ratio trade. There's a lot of logical reasons that you might want to gain exposure to certain assets as soon as you physically can, right? Both from an emotional perspective and a valuation speculation perspective. But just understand that the market is being prepared to give everybody equal opportunity to drive down the road in the biggest earthquake that Web3 has experienced to date.
And Cookies, it's very important to also note that the liquidity that's being harvested is not 100% being injected back into Pulsex. So when you remove liquidity, it makes it even more volatile. Because so if they did the exact duplicate of everything that's being harvested is injected back into Pulsex, that would make it less volatile, but that is not what's going to happen. And secondly, the whole reason why you have a 1.2 million X multiplication on Pulse compared to ETH, there's one reason why, and that is for the price of transactions. The fact that we're able to come in with 135 trillion Pulse compared to 120 million Ethereum essentially allows for our network to infinitum have cheap transactions on the network. It's the only reason why you're doing it. So we are harvesting everything, but everything is not going back into that AMM in Pulsex, which means it's going to be even that more volatile. And the reason why it's not going to go back in is because Richard's not going to allow a bank run on Pulse.
Yeah, I mean, not to mention users stand to benefit more from removing liquidity on Ethereum before the chain even goes live. So you've got another factor that's sort of limiting the initial at-stake play of available liquidity.
For anybody who's paying attention, it doesn't even make sense to leave the liquidity in there.
And that creates its own interesting games, right? Because now you have even less liquidity, perhaps on a major trading pair of the community, like Hex over on Ethereum. And so if you think that you're going to sell a bunch of your Hex on Ethereum right as Pulse Chain goes live, what you might experience is a huge exodus of liquidity from players who are just simply trying to hold on to their own assets at the time that the AMM bot's going to come in here and harvest these LP pairs. And that could in itself cause massive slippage to sizable bags that are trying to move after that play has been made and get into say cash or something that they want to bring across the bridge, whatever their weird strategy is.
Self slippage. That is.
Yeah, we were talking about this in the Pulse X chat a year ago, and in January of last year and May we were speculating to launch. So we were playing all these games out before. What's different now, in my opinion anyway, what's different now about the situation is that we're in a bear market. Before we were in a more of the end of a bull market. So there was more economic energy in terms of people coming in. Now people, I don't know if they're going to be wanting to get out as much as they wanted to get in before, but I guess that's all about.
You are best served letting your mind rest and knowing that the absolute chaos that will occur will only make sense in hindsight. And in each marginal moment of transaction, you will have enough volatility to paint whatever imaginary picture you care to see in that moment. But in the very next moment, the dead opposite could be presented, and you might just log off and not look because you got to see your imaginary painting that you wanted to see, and you don't care anymore. So your mind will be best served understanding that FOMO does not serve as a strong long-term strategy in investing.